All right. It's part 2 of chapter 6 for Accounting 651, where we talk about liquidations and some corporate acquisitions. So this is kind of without question a pretty tough area. So my intention is, once this video is over, to try to post some additional readings on these topics, as well as even a link to a different video. There are a couple lawyers out there that have tried to cover this topic in a video, not liquidations, but the 338H10 stuff. And so I'm going to encourage you, like, if I don't get it done, why don't you go watch one of theirs and see if that helps. And of course, you have your textbook as well. All right. That said, let's get going. Okay, so here's the overview of where we are, right? We've created the corp, we've operated the corp, we've talked about distributions, we've talked about transfers of ownership, and we're kind of now to liquidations, right? Which I've categorized as the reverse of contributions, and that's not entirely true. So we spent a lot of time on redemptions, right? Determining whether sale treatment or dividend treatment gets the nod. And we talked about substantially disproportionate redemptions, a complete termination of interest, a partial liquidation, and what it means to be not essentially equivalent to a dividend. So today we're going to talk about liquidations. We're going to talk about the treatment of a non-corporate shareholder, and then we'll talk about a corporate shareholder as well, specifically one that exerts control over the subsidiary. All right, so a little bit more on partial liquidations, even though really we've kind of run that gamut already. So a distribution is treated as not essentially equivalent to a dividend if the distribution is attributable to the distributing corporation ceasing to conduct or consists of the assets of a qualified trade or business, right? So we talked about that noticeable decline in the operations or business of the underlying entity. Immediately after the distribution, that distributing corporation needs to continue to be actively engaged in the conduct of a qualified trade or business. So they can't have almost shut everything down, right? They need to continue to operate some form of business. And the corporation distributes all of the assets and or all of the proceeds from the sale of the assets of the terminated business, right? So if we can meet those three, it sounds pretty good. So, and we talked about a qualified trade or business being any trade or business that was actively conducted throughout the 5-year period ending on the date of redemption and hadn't been acquired within that 5-year period as well, except in a taxable or partially taxable transaction. So, yeah, that's kind of a rehash of what we've already done. Really what I wanted to get to were a couple of these court cases that are indicative but don't really kind of fit within the regs as they're currently written. So let's start with U.S. v. Davis. This is a Supreme Court case. Said redemption qualifies for sale exchange treatment if not essentially equivalent to a dividend. And in Davis, they said, sure enough, these constructive ownership rules apply. So we have this issue of attribution. That redemptions from a single shareholder are always fatal. That doesn't mean that if one out of the many shareholders, that means if there's only one shareholder and that one shareholder tries to do a redemption, there's no way they're going to get not essentially equivalent to a dividend treatment. That business purpose was irrelevant, but there must be that meaningful reduction of the shareholder's proportionate interest. So the takeaways from Davis are a sole shareholder or pro rata for all shareholders is essentially equivalent to a dividend. Under Himmel, which was a appellate court case, there were 3 potential interests that must be reduced: voting rights or voting control, or interest in earnings through dividends, or interest in assets through liquidation. And the IRS rejected Himmel, saying that they would not acquiesce to that decision. We haven't seen a lot on Himmel since then, so it could be that we really need to stick with Davis or the regs. So meaningful reduction was left to the courts to decide. We know we have the 80-20 rule. There are problems when we start below 50% to begin with. And then lastly, when it comes to public company redemptions, these are often called tender offers. And even though these generally involved minuscule reductions in voting rights, they generally do get treated as not essentially equivalent to a dividend, aka you get sale treatment. So you should know that except in rare circumstances, a public tender offer generally does get redemption treatment. Okay, so now on to some new stuff. So we got through partial liquidations. That's when we get rid of part of a business. What about when we shut down the whole thing? So this is when a corporation winds up its affairs, it pays off all its debts, and distributes any remaining assets to the shareholders. So liquidation as a tax concept is the termination of corporate activities, the satisfaction of liabilities, and the distribution of the corporation's assets. And this produces sale or exchange treatment to the shareholder. And the liquidating corporation generally recognizes gains and losses upon distribution of its assets, with just a few certain exceptions. One giant exception, however, that we deal with separately is a Section 332 liquidation of a subsidiary corporation. So this exception applies to a corporation liquidating a subsidiary. All right, so where are corporate liquidations covered? Largely subpart A of subchapter C, that's 331, 2, and 4, cover the effect on the recipients. Subpart B in 36, 37, and 38 take care of the liquidating corp. And then subpart D defines what a complete liquidation is. Okay, so a lot on this screen. Let's assume that a closely held corporation is going to be liquidated. So this corporation owns a mixed bag of both appreciated and depreciated assets, with an aggregate fair market value of $2 million and an adjusted basis in all those assets of $500,000. And the shareholders collectively have an aggregate adjusted basis in their shares of $200,000. So what happens is a complete liquidation will generate a net gain of $1.5 million for the corporation. Right? And that's assuming all the gains and losses on the various items can be offset against each other, which is probably the case as long as it's all business property. The shareholders compute their gain or loss under 331 by subtracting their shares, the basis of their shares, from the fair market value of whatever their portion of the liquidating distribution is. So in this case, the corporation has liquidated all its property. So what's left is the cash that's left over after the sale of all the assets, the payment of all the liabilities, including, of course, the payment of the tax liability. So assuming a corporate tax liability of $500,000, which I think is, just a third, it's just made up, the aggregate amount distributed to the shareholders would be $1.5 million. If all the shareholders realize gains, their aggregate taxable gain would be $1.3 million, which is the $1.5 that they received less their adjusted stock basis of $200,000. So what you'll see is the complete liquidation produces the exact same tax result at both the corporate and shareholder levels, as if the corporation had sold all its assets to third parties and distributed the proceeds less its tax liability to the shareholders. So basically, a liquidation where the property is distributed versus a liquidation where the cash is distributed have no real functional difference between themselves. And that is by design. That is what the liquidation rules are built to deal with. So let's start with the treatment to the liquidating corp when we have a non-corporate shareholder. So 336 says, except as otherwise provided in this section, or 337, which really relates to the liquidation of subsidiary under 332, which we'll get there. Gain or loss shall be recognized to a liquidating corporation on the distribution of property in complete liquidation, as if such property were sold to the distributee at its fair market value. Okay, so let's distinguish this from a partial liquidation or redemption, or certainly a distribution. The significant part is or loss. So in a complete liquidation, gain or loss can be recognized. Whereas, as we know, on these dividend distributions of property, the corporation was not entitled to recognize the loss. So debt will not affect the gain or loss calc unless the debt exceeds the fair market value of the property, in which case the amount of the liability, the amount of the liability is the fair market value of the property. And of course, any gain or loss will increase or decrease the liquidating corporation's E&P. Losses distributed to a related party, however, are disallowed if, number one, the distribution is not pro rata. So remember, we dealt with non-pro rata distributions before. The issue is it starts to feel more like something a little bit persnickety's going on if it's non-pro rata. And so as a result, the loss distribution or the loss would not be permitted. And then there's a rule that talks about if the property is acquired by the corporation within 5 years of the distribution. That's something called the anti-stuffing rule. All right, so welcome back. I had a little break there. Someone came in for a little bit of office hour action. So losses distributed to a related party are disallowed if the distribution is not pro rata. We talked about that. And then this idea of the anti-stuffing rule, which is basically where the property is acquired by the corporation and then they liquidate in order to try to capture a loss that they wouldn't have been able to otherwise. So that's just an anti-abuse rule. So same is true with losses with a tax avoidance purpose. So 336D2, losses with a tax avoidance motive, then only the losses accruing after contribution of lost property to the corporation are allowed to the corporation on distribution. So the idea is if someone contributes lost property and then they try to liquidate out and capture that loss, really that's not much of an issue anymore, primarily because the rules on lost property require the step down in basis anyway. So 336D2 is a little bit of a legacy code section out there, but I think it could still be used in situations where they thought there was some abusive behavior on the part of the taxpayer. All right. So again, non-pro rata, I feel like we already covered this one time, but maybe I'm just dreaming. Non-pro rata does not mean that it's not consistent with ownership percentage. So let's say X Corp stock is owned 80% by A and 20% by S. And X Corp's ending balance sheet has cash, equipment, and a building on it. So what they want to do is distribute the, let's say, the equipment and building to one of the shareholders. Maybe he wants to continue to operate those things, and kind of the other one gets cash, right? So the problem is a building cannot be distributed 80-20. Well, I mean, it could, but that's pretty inconvenient. That now one shareholder gets 20% of the building, the other shareholder gets 80% of the building. So let's say that A gets cash and building. A gets equipment. I think that's supposed to be B gets the equipment, but maybe I'm wrong. So if A's a related party, there's only a loss on one of these items, and that's the $200,000 on the building itself. Notice that the market value of the building is lower than the basis of the building. So that's where the lost property is. So you would treat A as a related party, and therefore the loss couldn't be recognized. So what you would want to do there instead is distribute the lost property to S. S as a 20% owner is not considered a related party, and therefore the loss could be recognized. Now, naturally, the inclination is that S actually wants the building. So sometimes you can get caught in a pinch. All right. How about the treatment to the shareholder? 331, in a taxable liquidation, amounts received by the shareholder in a distribution in complete liquidation of a corporation shall be treated as in full payment in exchange for the stock, which means sale treatment. So a complete liquidation is treated like a sale, right? That's different than those redemptions where we had to kind of test to determine. The amount realized is the fair market value of any property they receive. The basis used to calculate gain is the shareholder's basis in the stock. So A owns 100 shares of Humdrum purchased for $10,000, therefore that's the tax basis in those shares. Humdrum has $12,000 of accumulated E&P, and Humdrum distributes $20,000 to A in exchange for A's stock in liquidation. Well, I'm very popular today. All right, back a third time. So A owns these shares of Humdrum. Humdrum distributes 20,000 in exchange for A stock in the liquidation. So we got a complete liquidation of Humdrum. A is a shareholder in Humdrum. So let's think about the result, right? So there's a $10,000 long-term capital gain, right? That's the 20,000 of distribution less A's basis in the shares of 10,000. And notice that E&P totally not relevant when it comes to a liquidation. So what happens is any accumulated E&P or deficit in E&P basically just vaporizes into the Ethernet and no longer means a thing. So gain is calculated on a block by block basis, not aggregate. I'll point out in a slide or two why that's relevant. And this is generally, of course, better than dividend treatment, and more so since what we'll see that 332 is really going to take care of corporate owners. All right, so here's why it matters based on a block by block basis. So let's say shareholder S holds 60 shares of X Corp, long term with a $30,000 basis, and 40 shares short term with a $50,000 basis. When S receives the 100,000 in complete liquidation of X, the amount realized needs to be allocated using the fair market value. So in this case, that's pretty straightforward, but the idea is, look, you don't just get to lump it all together and net the gains and the losses together if they have different holding periods. All right, 334, tax basis to the shareholder for any property received in a liquidation is its fair market value at the time of the liquidation distribution. And that's very consistent with taxable transactions between any entity and its owners. If the shareholder assumes liabilities, the amount realized is the fair market value minus the liabilities. But in that case, the basis is the fair market value of the property. Right, so that's very similar to the distribution of property in a dividend distribution as well. All right, any timing issues? Installment obligations distributed, things like creep in liquidation distributions. So what we really get into are instances where the consideration is being paid over time, or even really isn't completely known at the time that the liquidation takes place. So an open transaction is one where the value of the process is not readily ascertainable. The proceeds is not readily ascertainable. And a closed transaction is where the value of the proceeds is ascertainable. So 453J2 says the rateable tax basis recovery even when the selling price is not readily ascertainable. So what that means is, what we're talking about is the timing of the recovery of basis, right? So obviously we're getting sale treatment. If the proceeds are coming in step by step, in some respects you'd always prefer to recover basis first before you recognize any gain. Whereas think of it like as under the installment sale treatment, you recover it ratably as you recognize, as you receive the consideration or the proceeds. So if multiple cash transfers are occurring in the liquidating distribution, amazingly there's a revenue ruling that says you get full recovery of basis before reporting any gain. So think of that as receiving open transaction treatment, even though really it's a closed transaction. Now, the flip side of that is, of course, if it's at a loss, you wouldn't be able to recognize that loss until the final distribution, or you've at least exhausted all of your basis. 453 installment sale treatment says rateable basis recovery even when the selling price is not readily ascertainable. So what we have is a little bit of a fight here going on in the code, right? We got a revenue ruling and we got installment sale treatment. So this is an extremely sticky issue when the amount realized includes contingent proceeds. So a contingency would hold the liquidation open until the final receipt, and you would retain the character of the liquidation, which is likely to be capital. If, on the other hand, it's a closed amount, which means you are able to estimate the value of the contingent proceeds, then that closes the liquidation, and any post-closing adjustments to proceeds are now considered ordinary. Okay, so let's think about that for a second, because obviously there's a distinct difference here between an open transaction and a closed transaction, right? So the contingency holds the liquidation open until final receipt and would retain the character of the liquidation, right? So I'm a shareholder, I'm receiving proceeds over time, right? And I'm likely to be able to treat those as capital, right? Because I'm exchanging shares for that liquidating distribution, in this case, distributions. If, on the other hand, I'm able to estimate that amount at the time of the liquidation, then what would happen is any post-closing adjustments to my estimate would be treated as ordinary. So think of this as you can expect that the service is going to pressure you to a value when you're claiming a gain, right? Because what they want is they want to be able to close that liquidation and force you to recognize any excess or less as ordinary. But you can expect that to be considerably less so if you're claiming a loss, because then that loss doesn't get recognized until the final distribution. All right, so if a liquidating corp sells assets to a third party in an installment sale, okay, so now think about this. The liquidating corporation is getting rid of all of its stuff, and it sells assets to a third party, so this is unrelated to the shareholder, in an installment sale. And now what happens is that installment note is distributed to the shareholders. Installment treatment or installment sale treatment is available to the shareholders. The installment sale must be part of a liquidation plan and must occur within 12 months of the adoption. And this is not available if that stock was publicly traded. Okay. That takes care of non-corporate shareholders. Now we shift our attention to corporate shareholders. So 337 says no recognition of gain or loss results on a distribution of property by a subsidiary to its parent corporation in a complete liquidation, to which 332 applies. 334 says the parent corporation takes over the transferred basis for assets and any carryover, recapture of depreciation, etc. potential. So think of it as like this is treated as a non-taxable transaction where it's a little bit like that property has been contributed to the parent. There's no gain or loss recognition. Basis carries over. Parent corporation doesn't recognize gain or loss on the liquidation of the subsidiary. That is, Section 332 is mandatory. Also, the subsidiary recognizes no gain or loss on the property distributions to its parent. To qualify for 332 treatment, the parent must own 80% or more of the voting stock and total value of other stock, and the subsidiary distributes all of its property in a complete liquidation within the taxable year or within 3 years, and the subsidiary must be solvent. So the tax attributes simply carry over. Basis of property to the sub becomes basis of property to the parent. The E&P of the sub becomes E&P of the parent. So one of the problems with 332 treatment is that the parent's investment in the sub simply evaporates. Okay, so let's say parent P has a basis of $100,000 in subsidiary T's stock. T's basis in its own assets is $40,000. The fair market value of T's assets is $75,000. So P's made some investment in T, but unfortunately its basis is higher, so T hasn't operated particularly well. Now P liquidates T into P. So under 332, the amount realized, $75,000 minus the adjusted basis in the stock, is $25,000. But remember, no gain or loss is recognized. Instead, P takes over the property at its basis. So what happens to that additional basis it had of its investment in T? It's gone. It simply evaporates. This is a bad answer to the extent that a parent has a basis that exceeds, so think of that as outside basis. Their basis in the sub exceeds the sub's basis in its own assets. So in the liquidation of a subsidiary, it must be a complete liquidation. The corporation ceases to be a going concern, and any remaining activities are merely for winding up its affairs, paying debts, and distributing any remaining balances. However, legal dissolution is not required, although certainly legal dissolution is indicative of a complete liquidation. There is a permission to retain a nominal amount of assets, basically to preserve the legal existence of the corporation, right? So imagine that just keeping the legal entity means you have to file state legal papers and some other things on a year-to-year basis. So that means that subsidiary isn't completely liquidated legally and really does have a nominal amount of assets so that it can pay these fees and these sorts of things. And that can be done for trademark reasons and some other reasons, to the extent that there's a legal purpose for retaining that subsidiary. There should be a plan, right? We've talked about that with redemptions as well. There really you should always have a liquidation plan. Otherwise, there are 3 rules. You have to be able to show the intent to liquidate. There has to be a continuing purpose to terminate corporate affairs and dissolve, which means that the activities are showing a continuing effort to do so. And corporate activities are directed toward that purpose, not some other purpose, for example, continuing to operate. 3 requirements of 332B. The corporation receiving the property owns a specified amount of that distributing corporation's stock. That's the 80% rule. Complete cancellation or redemption of all the stock of the distributing corp, and that transfer occurs within time limits. So we know about the 80% rule. That's very similar to our other 80% rules, 80% of the voting power and 80% of the value of all stock. Steps to avoid 332, right? So imagine you get into a situation where you actually do not want 332 to apply to the liquidation of your corporate sub. For example, maybe you have that outside basis that really exceeds the inside basis. Then you may want to somehow treat it so that it doesn't. So maybe you need to dump some shares to get below 80%. You would need to do that clearly prior to the adoption of the liquidation plan, or else the step transaction is going to apply to that transaction. Need a complete cancellation or redemption. Technically, it doesn't need to be complete, meaning 100%, but there better be some reasonable basis for not doing so. Like there must be some reason that you need to preserve its legal existence. The plan must provide for the transfer of all property within 3 years from the close of the taxable year in which the first distribution is made. The distribution should be made within the year if no plan is adopted. Again, so another good reason to have a liquidation plan is it gives you 3 years to provide for the transfer of all the property as opposed to simply within the year. Okay. So this has to do with when there's a liquidation of a sub and it's not really a liquidation to get rid of the legal structure, but rather it's because the subsidiaries become insolvent and it's in exchange for repayment of the debt. So let's say parent is a bona fide creditor of the subsidiary and the subsidiary has become insolvent. So now what's going to happen is to pay off that debt, they're simply going to merge the subsidiary into the parent. So under the applicable state merger statutes, the transfer of assets from subsidiary to parent is made in satisfaction of the indebtedness, which recall that is a realization event, which means you treat it as a sale. Since all the property of the subsidiary is worth less than the debt, no part of the transfer is attributable to the stock interest of the parent. The transaction is therefore neither a non-taxable distribution under 332 nor a tax-free reorg under 368A, and we'll deal with the subtype A reorg in future classes. Okay, so the idea is when the transfer is made in satisfaction of the indebtedness, that's not a liquidation. All right. So recall that a subsidiary does not recognize gain or loss on distribution of property to the parent. So what happens if there's a liquidating distribution to a minority shareholder? So again, you only have to own more than 80%. So let's say that you own 90% and some other minority shareholder owns 10%. So the subsidiary corporation is treated in the same way as in a non-liquidating distribution. The distributing corp recognizes gain but not loss with respect to the amount distributed to minority shareholders. The minority shareholders also recognize gain or loss, the amount being the fair market value of the property received less any basis they have in the stock, of course. So P Corporation owns 90% of X, and J, an individual, owns the other 10%. X has assets with a basis of $1 million and fair market value of $300,000, which are then distributed to P and J in liquidation. What is P's recognized gain on the liquidation? Well, P owns more than 80%. It's the liquidation of a sub into a parent, and so as a result, there's no gain or loss, and the basis will carry over, but I guess we'll get there in a second. What is X Corp's recognized gain on the liquidation, however? Normally that would be zero, but because of this minority interest, you calculate the gain that would apply. That's the $3 million of fair market value minus the $1 million of the basis in the assets. That's $2 million. You multiply it by the minority interest ownership percent of 10%, and they're going to need to recognize a $200,000 gain. What is J's basis in the assets received from X Corp? Well, normally they would have carryover basis in those assets, but because there's been a minority interest triggering of gain, $300,000 of that basis is what gets carried over on the distribution to J. Okay. Now's when it gets really hairy, and my advice is, if you really don't understand it, go through the book again, or go to those other videos that I will post in Blackboard for you. Okay. Asset acquisitions, the acquisitions of the assets of a corporation. This is generally a taxable transaction. The corporation recognizes tax on the gains, and the buyer gets a step up in basis to market value. In a stock transaction, however, this is when someone acquires the stock of a corporation. This is also generally taxable. The seller sells stock to the buyer and recognizes capital gain. So let's think about how that differs, right? So in an asset acquisition, someone is acquiring the assets of a corporation. In a stock acquisition, someone is acquiring the stock of a corporation. Well, typically, the stock isn't held by the corporation, it's held by the shareholders. The property, on the other hand, is held, or the assets are held by the corporation. So in A, we've got this acquisition of assets from the corporation by some acquirer. In B, someone's acquiring the stock from the shareholders. The shareholders recognize capital gain, but the corporate entity basically stays intact, and the bases of property and all the other tax attributes simply carry over, right? That would be a little bit like anyone selling their shares of any corporation to some other person. Assets are generally considered cleaner from a legal perspective. The first is, whoever the buyer is only getting the assets that they decided to buy. So there shouldn't really be any hidden liabilities. However, they also must retitle all the assets to a new owner. The liabilities conveniently can be left behind with the previous owners, and of course they can cherry pick the assets thereafter. Stock, on the other hand, in a stock acquisition, you buy the stock, you get the equity, you own all the assets and all the liabilities. Now, there's no retitling of the assets, right? They did belong to the corporation. They continue to belong to the corporation unless, of course, you engage in a liquidation after the acquisition. So legally, it's often considered easier to have a stock acquisition, but you may pick up some unwanted assets, and you also have the trouble and headaches of dealing with some minority shareholders that may not be that keen on selling. Okay, so when we have a corporate sale of assets, this is a basic sale of corporate assets. You end up with the amount realized minus the adjusted basis. You get a realized gain or loss. We know about the amount realized calculation. Gains and losses are added up or subtracted from E and P. Any losses would be limited to capital gains 3 years back, 5 years forward, etc., etc. All these kind of basic corporate rules. If you purchase multiple assets, each asset is figured separately, so you'd have to allocate the amount realized across each of the assets based on fair market value. So X Corp purchases a commercial lot for $2,005 and $30,000, and then it builds a warehouse on the site in 2006 for another $60. Depreciation on the warehouse of $32 is taken up through the sale date, and then Both the property and the warehouse are sold for $110,000. This is the acquisition of assets. So first we would need to allocate the sales price to the land and the building based on fair market value. Well, let's say the fair market value of the land is 40, the fair market value of the warehouse is 70. So you'd end up with a $10,000 gain on the land, a $42,000 gain on the warehouse. Now, fair market value is important to both the seller and the buyer. So the reason is the seller cares because there could be depreciation and recapture and holding period effects. The buyer cares, particular in this case, because land is a non-depreciable property, whereas of course the warehouse is depreciable. So basically what you would like is the allocation to something depreciable to be higher, because that way you get to depreciate that. And an allocation in a sale agreement between a buyer and seller will generally be respected unless there's some notion that there's tax avoidance going on. So let's say that instead A is the sole shareholder in Target Corporation and has $100,000 in her T stock. So T's only asset is land with fair market value of $400,000 and zero adjusted basis. Now, I'm not really sure why you have zero adjusted basis, but roll with me. The buyer corp wishes to acquire the land for $400,000 in cash. So let's think about the three options that this transaction could take place in. So number one, they could liquidate T, distribute the land to A in a complete liquidation, and then A sells the land to B. So let's think about how that would work. T would recognize the gain, right? So they would recognize a $400,000 gain. And then A would recognize gain on the deemed sale of the stock as part of that liquidation, right? So they obviously would receive the net proceeds of $400,000 minus taxes over their stock basis of $100,000. All right, how about instead T sells its assets, then liquidates. So T instead sells the land to B for $400,000, then liquidates, distributing after-tax proceeds to A. That doesn't feel a lot different, but we'll unpack that a little bit. And then the third option would be, what if instead A just sells her shares in T to B for $400,000, and then B liquidates T and distributes the land up in, let's assume that B is a corporation, which it is, in a 332. So how do we deal with these alternatives? So let's start with the liquidation of T, followed by the shareholder sale of assets. So T distributes the land to A in a complete liquidation, then A sells that land to B. T recognizes gain, A recognizes gain. T recognizes a $400,000 gain. So what happens is A is going to bear the burden of T's taxes because, of course, T has nothing left. And thus A has a gain of $160,000, which is the $400,000 minus the $100,000 basis in the stock minus $140,000. That's assuming the old 35% tax rate. It would be less than that today, but obviously A's still going to have to pick up the taxes. And so A takes a $400,000 basis in the land and then sells that land with no gain or loss to B. So what is A left with? A is left with, in this case, $236,000. So that's $400,000 minus the $140,000 of corporate level tax, then minus the $24,000 of A's individual tax on the gain. Now let's look at number two, when we have a sale of T's assets followed by the liquidation. So now T sells the land to B for $400,000, then liquidates, distributing the after-tax proceeds to A. So T recognizes a $400,000 gain, pays the same $140,000, again assuming 35%, of taxes at the corporate level, leaving $260,000 to distribute to A in a complete liquidation. A recognizes a $160,000 gain, $24,000 in cap gain taxes, and B takes a $400,000 basis in the land. You can see that under either of these approaches, the end result is identical, and that is by definition. That is exactly how these are supposed to be. Now, this third option where the sale of T stock, A sells her shares in T to B for $400,000, then B liquidates T and distributes the land to B, we're going to defer that for a second because we need to walk through a little bit more of an understanding of asset purchases. Then we're going to loop back around to this. Okay, So a purchase of a trade or business typically involves a bundle of different assets, and that typically includes intangibles. So, and history reveals a proclivity on the part of taxpayers to assign fair market values to away from long-lived intangibles and into short-lived intangibles. And the reason for that is because, of course, you used to be able to amortize the cost of those short-lived intangibles over their useful life. So then Section 1060 rolls along, and it says, you know what? We're gonna prescribe a way that you're going to allocate value to each of these assets. So, and what we're going to say is the consideration received for assets shall be allocated among such assets acquired in such acquisition in the same manner you would do so under 338b5. In connection with an applicable asset acquisition, the transferee and transferor agree in writing as to the allocation of the consideration or as to the fair market value of any of the assets. Such agreement shall be binding on both parties unless the Secretary, which is the Secretary of Treasury, determines that that allocation is not appropriate. Okay, so for purposes of this section, the term applicable asset acquisition means any transfer of assets which constitute a trade or business with respect to which the transferee's basis in such assets is determined wholly by reference to the consideration paid for such assets, which would be the case in, of course, an asset acquisition. So the idea is you're supposed to use what's called the residual method, which means you allocate basis on a sequential and hierarchical basis. You file Form 8594, which we're not going to make you guys do, but it is an interesting form to look at just to see how it scopes out. So the classification of certain assets under IRC Section 1060. So first, everything is allocated to cash, right? Because cash is always a basis. That's super easy to identify, and so typically the fair market value is fairly simple to pinpoint. Then to certificates of deposits and marketable securities, then to accounts receivable, then to inventory, then to tangible realty and personalty, then to 197 intangibles, and then anything left over goes to goodwill. All right. So Section 197 intangibles are ones that are acquired as part of the purchase of a trade or business, and they are all amortized over 15 years. And part of that is it takes away the advantage to trying to shift fair market value between different intangibles. That first off, the fair market value is difficult to pin down, and it might create incentive for taxpayers to try to do so. All right. So total proceeds to be allocated can be made more complex through indemnification escrows, which is, well, what if I'm trying to indemnify the buyer against some sort of future liability? If there's a contingent purchase price, because as we know, this can leave open or closed transactions. So deferred payments made in an open transaction in rare and extraordinary circumstances. The payments are so contingent and so speculative that the value is not reasonably ascertainable. So what that means is 1060 really doesn't want you to leave an open transaction. Okay, one last area I want to talk about is an asset sale by a corporation without liquidation afterward. Okay, so let's imagine that what we have is this corporate sells all its assets off, but it maintains its corporate form. It does not liquidate. So what happens is there's this deferral opportunity, right? So first off, if they don't liquidate and send the property or cash out to the shareholders, then the shareholders avoid the shareholder level tax. And of course, that can be advantageous for the shareholders if they can keep that stock held that way until they die. And then their heirs get a step up in basis in the stock, and they basically avoid that shareholder level gain in perpetuity. So the first thing is you could trigger personal holding company status, which is if you have a corporation and it really is only holding passive investments, you're going to get whacked with a personal holding company penalty tax. And that was back in Chapter 3, I think. We talked about that a little bit. And the other thing is you could try to convert the corporation to S-Corp status. But you can get into trouble if the S corporation has too much investment income after having been a C corp. And we're not going to really get into that, but that basically shuts down that planning opportunity. Okay, so lastly, let's kind of summarize here for a second. So let's think about what the seller wants. The seller wants to sell the target stock, not the assets. So if the target corporation sells assets, then it's going to want to allocate proceeds to those capital assets producing long-term capital gain. For individuals, there's a rate differential. For corporate sellers, there's no rate differential, but they might need to consider possible cap loss carryover utilization. Generally, the buyer wants to purchase assets, not stock. And that's primarily so the buyer can take fair market value in the basis of all those assets and therefore recover them at the cost that they actually paid for them. They're going to want to allocate the purchase price to inventory and other short-lived assets. That enables a prompt income tax deduction of those costs and, of course, minimizes the allocation to goodwill and these other 197s that take 15 years to recover the cost of. Okay. Now we can look at this third perspective, which is, what if instead T sells the stock to B? So in this case, it's actually A selling the stock. So the sale of T stock, A sells all her shares in T to B for $400,000. Then B liquidates T and distributes the land up to B. So let's think about how that would play out. A is going to recognize gain or loss only on the sale of shares. Ooh, that's very exciting to them, right? Because now there's not two layers of tax for A, there's only one. The difference is B takes the cost basis in T shares. So that's the carryover basis. So even though in this case it was land, I think, but even if it is land, B paid $400,000 for it, but they only get basis in it for what the carryover basis was. Remember, that was zero. So A's super happy. They get cap gain treatment, no corporate level tax. B's super unhappy. They paid fair market value for the assets, but don't recover any of their costs until their shares of T are sold. So recall that if B liquidates T, then 332 applies and the basis carries over. And what happens to that extra basis? Boom, evaporates. So stock acquisitions create this difference that in largely we think of shouldn't be affected, right? At the end of the day, all of these transactions should arguably be treated the same. That was either T liquidated and distributed the property to A, then A sold the property to B, or T sold the property to B, then liquidated and the proceeds went to A, or the sale of the stock of T by A. They should all be the same. All we're doing is shifting these assets around between owners, but we can see that they are not. Okay, so somehow we need to try to fix this. And years ago, the first thing they tried to do was this Kimball Diamond concept, and it was a total failure. So the second thing they did was they created Section 338. And what we're going to show is that an election under 338 is probably only advantageous if the target either has NOLs or other built-in losses to offset the gains on a deemed sale of appreciated assets, or there's just some other reason to try to cleanse the target's tax history. The third fix was 330H10, and now the most recent fix is 336. And so what we have to do is walk through how the code is trying to correct this difference in the acquisition of stock from the acquisition of the assets, when kind of for policy reasons there should be no difference. Okay, so the tax consequences. Parent Corp P has basis in target subsidiary T's assets that equals the basis in the subsidiary stock. So T may but need not be liquidated in a 338 transaction. What happens is when you elect 338, T is deemed, so that target is deemed to have sold its assets for an amount determined with reference to P's basis in T's stock, adjusted for the liabilities of T. So therefore, gain or loss is recognized by T as if sold for fair market value. So think about this. In a 338, we have a stock acquisition. Normally, T would not recognize any gains or losses. Under a 338 election, T is going to recognize gains or losses under a deemed sale. The subsidiary is treated as a new corporation that purchased all of its assets on the day after the qualified stock purchase date. Now, what that means is those tax attributes don't carry over. So it's as if we're treating a stock acquisition like an asset acquisition, and it's being done through this deemed sale of assets. So what are the requirements? Acquisition by purchase by a corporation of at least 80% interest in another corporation in a 12-month acquisition period. The purchasing corporation must be acting alone. So what that means is the 338G election is made by the purchasing corporation, and it's treated as a hypothetical sale for the market value of the assets on the acquisition date. Purchasing corporation has the income tax payment obligation for the recognized gain. The corporate tax liability on the deemed sale from old target to new target stays with target, which the stock purchaser has now acquired. So let's think about that for a second. P is acquiring shares from the shareholder of T, but we're going to make a 338 election and treat it like an asset acquisition. And the way we do that is through a deemed sale of old target to new target. And the buyer gets whacked with the corporate tax. Let's compare that to how that used to happen. In the acquisition of assets or the liquidation and then the acquisition of assets, recall who got whacked with the tax. That was A, the shareholder in T. In this case, it's actually the buyer. Okay, so T's tax liability, we just went through this, right? P bears the cost of T's tax. This is going to create a problem. And to show you how, we're going to walk through some hypothetical examples. So let's recall the simple asset purchase. A owns 100% of the stock, basis of 200 of X, which owns one asset, a rented machine with a value of $1,000 and basis of 200. X has no goodwill. Assume the applicable tax rate on all taxpayers is 25%. Obviously that wouldn't be true, but it's a nice simplifying assumption for walking through so that we can isolate really what we're looking for. If X sells the machine to Corporation B for $1,000 and liquidates, okay, X is going to recognize a gain of 800. That's the fair market value of 1,000 minus the basis of 200. It's going to pay 25% or $200 in tax. B gets the step up in basis that they want. B takes a $1,000 basis in the machine. A is going to receive $800 in the liquidating distribution. We'll recognize gain of $600. That's the $800 of proceeds less their $200 difference, and pay tax of $150, netting $650. A and X together will have paid $350 in tax. Stock purchase version 1 under 338. Now instead, B buys the X stock for $1,000. And they do that on the mistaken assumption that the stock is worth the value of the underlying corporate assets. We're going to see why that's not true. And then it's going to liquidate X under 332. So A recognizes a gain of $800 on the sale of stock and pays tax of $200. X has no gain or loss recognized. B will hold the machine at the basis of 200. So let's think about what happens. If B sells the machine, then it will pay $200 tax and net $800. Thus, B will have lost $200 economically because it paid too much for the stock. Let's think about that for a second, because it failed to account for the built-in tax liability, which you could view as the potential tax on the disposition of the machine or as the potential loss from the lack of depreciation of the $800 of basis that B doesn't get to enjoy, right? Because the basis carries over. B will not have a tax loss to accompany its economic loss because that basis in X stock evaporates on the liquidation of X into B. So A and X, much better off. B, not happy. Let's do version 2. B buys the X stock for $1,000 and makes a 338G election. Okay, so A recognizes $800 gain and pays $200 in tax. That's the same, right? So A gets rid of its shares, it gets the $1,000 for him, pays its tax. X is now deemed to sell the machine for its value of $1,000, and X will pay $200 in tax. If X is then liquidated, B will receive the net value of $800, and again will have lost $200 because again B as the purchaser has to pay X's tax. But at least B will hold the machine with a $1,000 basis. So now B stands to save that $200 over the life of the machine, assuming the tax rate remains at 25%, through savings from depreciation on the $1,000 basis rather than the $200 basis. The problem with 338G is that the discounted present value of $200 in savings over the depreciable life of the machine is clearly less than the $200 they have to pay at the time of the 338G election. So in other words, you can't really spend $1 today to save $1 in the future because that future dollar is worth less. Moreover, B will literally be charged with a separate asset of goodwill under the regulations residual allocation rule, and that goodwill will have a basis of $200. But there is no goodwill, so it's unclear if B could ever write that off, but it's probably 15 years. How about version 3? So based on what we just learned, B will only want to pay $800 for the stock, right? Because they just realized, oh, there's a hidden liability, a hidden tax liability when I make that G election. So if B buys X's stock for $800 and no G election, A recognizes a gain of only $600, but of course it also only receives $800. So it's really paying the implicit tax, right? It's paying the tax by receiving less proceeds. So A's effectively paid the $200 built-in gains tax on X. B gets basis of $200 in the machine. A will net only $650 after A's own tax of $150, the same as if X had sold the machine for $1,000, paid its $200 tax, and liquidated. So now neither B nor A are completely happy. B's basis in the asset's only $800, and A gets whacked with all the extra tax. So really, A should have just sold the asset and liquidated. Okay, this is the problem with 338. Let's do one more version. B pays $800 for the stock and now makes a 338G election. So X is going to be deemed to sell the machine to itself for $1,000. That $200 of built-in gain is counted as a liability that increases the $800 stock purchase to a price of $1,000. That's now the deemed sales price of the machine. So they pay $200 in tax. Okay, let's walk through this for a second. What happens to A? A recognizes a gain of $600, pays $150 in tax. B takes a $1,000 basis on the machine. So the $350 in tax that's been paid is now the same as if X had sold its assets to Z in the first place. So we finally matched it, right? We adjusted the sales price down to $800 to reflect the fact that we're going to gross it up by the tax liability. A ends up paying the tax that they would have paid because in some respects, think about it. A was the owner of this property during its gain period. A really should pay all the tax. And B gets the step up in basis and did the stock acquisition that it really wanted. So you can see that in version 4, we kind of got to where we needed to get to. Okay, so 338 has achieved some parity with an actual asset purchase. The choices facing the potential corporate or non-corporate acquirer of most or all of the stock of a target corporation having substantially appreciated assets are stark. So you either pay full value for the assets and obtain cost basis that yields commensurate tax benefits in the future, or try to buy the stock at a price discounted from the inside asset value to reflect the potential corporate tax on the built-in gain. Okay, I'm going to go back a slide to talk about that for a second because I think it's meaningful. So remember what happened. B only paid $800, by paying $800, A implicitly paid a part of the tax on this deal. Therefore, because of that, A and B are in a position to negotiate how that tax is going to be shared, right? So A doesn't have to accept $800. They could say, no, I'm only going to accept it at $850, or I'm only going to accept it at $900. And then what happens is that implicit tax is going to be shared between the two parties, right? B's going to get that step up in basis, and A's going to increase the amount of proceeds they receive. It'll increase their gain some, but at the end of the day, they still end up with a greater amount of proceeds. So 338 is a competitive outcome between the two parties. The seller result is the tax on the gain of the sale of stock, and the seller's not responsible for the tax on the hypothetical sale. The buyer gets the stepped up basis in assets and pays tax on the hypothetical sale. The tax attributes end through liquidation, and now the target emerges as a new corp. That is exactly where we started. Okay, so let's talk about how these items are actually calculated. So T is treated as hypothetically selling its assets, right? So it's old T becomes new T. The way you do that is you calculate the aggregate deemed sales price, or the ADSP. This is the price allocable to the assets deemed sold by the target. The target is treated as selling those assets for ADSP. So if all of T's stock is purchased at once, it's super easy. However, it is not easy if all of T's stock is not purchased at once. So far we've been dealing with a complete acquisition of all of the target stock in one sales transaction. But guess what? It doesn't always happen that way. In fact, a lot of times it doesn't happen that way. So the grossed up amount realized on the sale of T's stock to P on recently purchased shares. So let's say P purchased 80% of T's stock for $800,000 in the last 12 months. The ADSP would be the grossed up amount. So that would be $800,000 divided by the 80% acquired, or $1 million. And then to that you would add the liabilities of old T, including any tax liabilities from the deemed sale. New T's basis in the assets is the new fair market value cost basis, but again, not really. So there is a distinction between ADSP and AGUB, the adjusted grossed up basis. So you would think those would match, and in some instances, in very simple instances, they do. But in some instances, they do not. So the adjusted grossed up basis is the grossed up basis in P's recently purchased stock, grossed up for the shares not owned, P's basis in non-recently purchased T stock, and the liabilities of new T, including that tax liability. So the objective of determining this tax basis is determine the amount to be allocated to target's various assets after the deemed asset purchase. This tax basis is allocated to the various assets as specified under the 1060 approach we already walked through. And if all the stock is purchased in a 12-month period and there are no contingent liabilities, then the ADSP will equal AGUB, but that isn't always the case. So P acquires all of T's stock for $3 million, elects 338. The AGUB of T's assets is $2.4 million. What happens to the excess of the AGUB over the fair market value of the assets? Well, according to the 1060 rules, you just give $600,000 to Goodwill. Okay. Recall that when the buyer is doing a 338 election, they get tagged with the tax. The hypothetical sale of assets is deemed to occur on the buyer's watch. So parent P owns target T and has a greater stock basis than T's basis in the assets, which is the typical issue. But the fair market value of T's assets also exceeds basis. B wishes to purchase T's assets and, of course, wants a step up in basis. So P liquidates T into P. Recall there's no gain or loss recognized for P or T, and P then sells T's old assets directly to P. P recognizes gain on the sale of assets, but does not recognize the gain on the sale of stock because of 332. B gets the stepped up basis. This does not work in a stock deal. And the question is, Shouldn't it? Okay, that's where 338H10 comes along. This is the acquisition of the stock of a corporate subsidiary. So a parent corporation is a seller of a target subsidiary corporation. So the idea is the target is going to be acquired and it's going to be kept alive. So the deemed sale is going to happen on the parent's watch. So let's already draw the distinction. In a 338G, the buyer got tagged with the tax. In a 338H10, the seller gets tagged with the tax. A 338H10 election treats the transaction as if it were a sale of T's assets while T is a member of the parent's consolidated group. And then the old target liquidates tax-free into the parent under 332. Okay. So T is 100% sub of P. That's the seller. B wishes to acquire T. T's stock is valued at $400,000 as are T's assets. P's basis in T's shares is $100,000, and T's basis in its own assets is $100,000. P and B are going to make a joint 338H10 election, and that's the only way you can do 338H10 is both the seller and the buyer agree. So old T sells the assets to new T. Then new T distributes the assets to S and liquidates. Okay, let's think about that for a second. Old T sells the assets to new T. That's a deemed sale. Doesn't really occur. Then new T distributes the assets out to the seller and liquidates in a hypothetical transaction. P does not recognize gain or loss on the sale of its T stock. B inherits all of T's attributes. T is treated as having sold the assets at fair market value. The gain or loss is included in P's consolidated return. The seller pays the tax, and B takes T's assets at AGUP. So this is generally advisable because it avoids double taxation while providing a step up in the inside asset basis to P. With this said, it is extremely beneficial in the following two variations. The first is the seller has a potential gain on the stock, so it has very low outside stock basis, but the inside asset basis is higher, so that the gain is smaller from an asset sale. In this scenario, the 338H10 election provides the same result as if there were an actual liquidation of the target into the parent, and then a sale of the target's assets by the parent. The other thing is, if the seller consolidated group has losses from other operations which can be used to offset the gain on the deemed asset sale. And again, this requires a joint election. So 336 is the last of our four. This allows the parent to treat a disposition of a subsidiary stock as a deemed assets disposal, same as 338H10. However, 336E is broader because it applies to any disposition of a subsidiary stock, including dispositions to individuals. 338 only applied when the purchase of stock was by a corporation. Okay, so that's really it. I'm not going to dig in on 336 any further. That's probably more than enough to deal with. I'll post some additional stuff for you guys to both read or watch if you want to. Because 338H10, 336, these are tough areas to deal with. And I guarantee we're going to have to go through some exercises in class to fully understand them. Thanks for watching what amounted to a long video.